Back. Wow, we have yet another FOMC meeting ahead of us. In the next 2 minutes, we are going to be getting a release from the Federal Reserve in terms of how much interest rates will be going up. It is all but certain that the interest rate hike will be 75 basis points. We will look for changes in the text that the FOMC provides in their statement of release. Are they going to talk about the economy slowing? Are they going to talk about a developing wage price spiral? Are they going to talk about how if we subtract from CPI numbers shelter inflation, we have no inflation? Are we going to talk about how one of the last dominoes to drop in an inflationary era is consumer spending? That's because businesses are hit first by credit costs going up, as well as sensitive sectors like real estate, whereas individuals can simply shift from credit card loans to personal loans and actually lower their effective rates, which is a lot of what's happening right now, leading to continued spending in the travel and leisure sector. That, of course, is expected to be the last shoe to drop. We'll see. We'll see what the Federal Reserve says. The Federal Reserve does have a big risk here of, unfortunately, being too soft. And that doesn't bode well for the stock market. That's because we have a jobs report coming out this Friday in 2 days. That'll be critical to the Fed. We'll have another CPI report next week. Then we'll have another JOLTS report. Then we'll have another jobs report. Then we'll have another CPI report, all before the December meeting of the Fed. So the Fed really has no incentive to be nice to us today. In fact, the Federal Reserve has every incentive under the sun to talk dirty to us today, to tell us about how bad inflation is, and to talk the stock market down. Because if the Federal Reserve talks the stock market up, guess what happens? Stocks rally, yields fall, and financial conditions loosen. That's not what the Fed wants. The Fed wants to see financial conditions tighten, not loosen. And therefore, I expect a hawkish Fed today, but we'll be looking for any sign of a dovish pivot from the Federal Reserve. Now, the statement is expected to be released within the next 20 seconds. I have our multiple resources up for this statement, and we'll get it to you the second it's available. So here we go. We got about 10 seconds. Again, we are expecting 75 basis points. That would really be anything other than 75 would be a substantial surprise. And we have 75 basis points. We have exactly what we expected. A 75 basis point hike just came out. That was not a surprise. 75 is here. We have the Fed sees the need to continue to ongoing rate hikes until we are at levels that are sufficiently restrictive is the word that's being used. We have the Fed saying it will take cumulative tightening, but they are starting to take lags into account. Oh, that's a little bit in the dovish direction. I like to hear that. The Fed says growth in spending and production is modest. The Fed says they're highly attentive to inflation risks. Okay, that's normal. Taking the lags into account, that's a new one. I like to see that. Let's go ahead and pull the statement up together here. So again, we got 75 here from the Fed. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances. So far, this is broadly similar. Russia, Ukraine causing tremendous economic hardship and human hardship. Seek to achieve maximum employment over the longer run. They decided to raise rates by 75 basis points. They're trying to get to 2% over time. Let's see here. This is the fourth straight 75 basis point hike. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Now that I like. To me, that seems like a little bit of a softening now that they're referencing the lag. So in my opinion, that actually looks good because we don't want the Fed to be blind to this idea of let's just hike, and then they hike us into a Great Depression. You need a Fed that's reasonable and realizes, look, there is a lag in the jobs market. Not only is there a lag in the jobs market, but there's also a lag in rental inflation for houses. Let's look at how this statement compares to the previous statement. You ready for this? Here you go. Okay, in blue is what is different. And look specifically at what we've got here. They added this entire section right here in determining. Here, let me move myself up really quick. But this is a big deal. This entire section here has been added. Here we go. I'll put myself right there. Okay, so here it is. In order to attain a stance of monetary policy that is sufficiently restrictive to return to 2% over time, they're raising rates 75 basis points, fine. In determining the pace of future increases, the committee will take into account the cumulative tightening and the lags. That right there is such a critical word, and in my opinion is actually a bit of a dovish tilt here from the Fed. Much more than we could have really asked for from the Fed. Otherwise, really happy about that. So if I had to give a quick breakdown on the summary, 75 basis point hike from the Fed was no surprise. A big surprise though was the inclusion of the phrases, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. That's great. Like I'm really happy about that. So let's go ahead and take a listen to briefly what we've got markets reacting with. We'll start with CNBC and then we'll go to what some of the suits are saying. Let's take a listen over here.
For the bulls that are out there, look, we just moved 50 points in the S&P 500, 300 points in the Dow easily on that. And that's close enough. Now, on the press release, in the press conference, maybe he'll talk, more clearly coded words. He'll say two-sided risks or risks of slowing growth, something like that. But this is a fairly nice bone to throw to the bulls right now. I think the problem right now for the market is the job market's not cooperating. These JOLTS report, the ADP stronger, and people are afraid the Friday jobs report is going to be a lot stronger than expected. But look how far we've come here, guys. 3,900 on the S&P 500. We were at 3,550 just a couple of weeks ago. Dollar's a little bit lower. Two-year yields have flattened out a little bit, so it's understandable why the market has rallied. But this has really been very impressive right now. The problem for the market now is what else are they going to really say to get the market notably higher? We're already trading nearly 17 times forward earnings with no change in the earnings estimates of about $230 for next year. This is a lot of expectations.
I'm just going to look, I'm going to come out and just be blunt about this. We know the Federal Reserve is going to stop hiking at these crazy 75 basis point levels. We know that hike is going to stop. We expect the next hike from the Fed to be 50 basis points and not 75. However, the Fed has to thread a very fine needle. The Fed needs to balance that. On one hand, if they do too much, they could irreversibly damage our economy. And they could end up turning us into Japan, where we lose a decade or more of growth and production because the Fed has led to so many unnecessary bankruptcies and collapses of businesses. That's the if the Fed does too much side, right? On the other side, the Fed's worried about doing too little, because inflation expectations have been rising. And when inflation expectations rise, you risk having uncontrolled or runaway inflation. Let's go ahead and get the 5-year break even though it trended down all through right around the beginning of October. And I'll get the line chart here. It's been trending back up. The Fed needs to work to end that trend to the upside. And they do that by maintaining a rigidness or a toughness in the way they talk about the market and the way they communicate their future policy. Understand this chart right here. I'll get rid of that extra box here. Hold on. There. This chart is really important to the Fed, because look at this, folks. As soon as October started, what did you get? You got this belief that, oh no, inflation expectations are starting to run hot again. When we hit this bottom right here, this bottom, if I drag this out to 5 years, that bottom actually is the top of inflation expectations in 2018, when we were hiking so much that Donald Trump said it's time to fire Jerome Powell. So keep this in mind, like, these are high levels where we sit now with inflation break-evens. These are insanely high levels over here. This is when you had war-driven inflation, right? You got a little bit of Omicron fear over here that quickly subsided. You got war inflation over here being built into expectations for the markets. We thought inflation was trending down, but then we got a few nasty surprises on inflation, and concerns grew that the Fed was losing control of inflation. And so we really need this line to flatten and trend back down. And I think that's why we're going to continue to see an overall hawkish Jerome Powell, but they don't want to be so hawkish that they absolutely destroy our economy. And that is exactly why I believe this phrase, I spotted it right away, and obviously we've seen it in the blue change tracking that I ended up bringing up on screen after we first came up with it. This is the blue change tracker, right? We've already gone through that. But when we look here, it was the first thing I noticed was, oh my gosh, they're actually referencing the realization that their policy moves with a lag. And this is true. Where is that true, though? Let's talk about that. First, you kind of have to think about this from sort of a larger macro point of view, okay? So first, rates go up. What rates go up when interest rates go up? This is important. And remember, Jerome Powell speaks at 11:30. Jerome Powell speaks. I'm just going to put this up on screen right here. There we go. So how does this work, right? Like, how does monetary tightening work? How does monetary I'll just say, how does monetary work? There we go. That's good enough. Okay. So first, you raise rates. Okay, great. Well, for whom are you really raising rates when you raise rates? Well, sure, credit cards go up, but if you can move to savings or to personal loans, that doesn't affect you so much. Instead, what gets hit are usually interest rate sectors, interest rate sensitive sectors. These would be things like cars, home loans, and businesses. Businesses financing things like equipment purchases, or anybody getting the SOFR rate, the LIBOR rate, the Wall Street prime rate, the Wall Street Journal prime rate. Those are rates that move immediately. Anybody who's on a variable term, right? These are the places where you're getting hit. Unfortunately, that's actually not, for the Fed's purposes, unfortunately, but actually good for people, that's not your consumer, not the consumer. That's why you're seeing this staying power in the consumer. What are they still doing? They're still buying Chipotle burritos. They're still buying air travel. They're still doing Uber and Airbnb. Maybe not as much as we've seen, but still very, very strong, to the point where you have American Airlines tell us we're seeing no reduction in demand. Now, eventually this slows. I think the last shoe to drop is the consumer. In fact, if we look at spending relative to household net worth, we tend to see household values and homeowner equity decline first, and then people stop spending as much money on things like home improvement products. Because remember what Home Depot has told us. Home Depot and Lowe's talk about this, but recently Home Depot tells us when prices of homes go up, people believe money they're spending on their homes is an investment. When prices of homes are going down, people believe that money they're spending on their home is an expense. And so when you look at a report this morning out from, for example, Generac. Okay, look, this is what I do, by the way, is every single day I just sit here and I read reports, okay? That's why I appreciate you subscribing and coming to the course member live streams if you're a course member. By the way, we're changing the pricing for November, I think this afternoon, so you still have a little bit of time to get in using that Halloween code if you want to. But look at this report specifically from this morning. So here's a report from this morning. And what does it tell you? Well, we already got preliminary numbers from Generac a few weeks ago. So we know they've been complaining about installation sales. But what was a surprise this morning beyond slow installation sales? Well, a headwind that we're starting to see is that commercial sales are up 20%, but residential is only growing at 9%, whereas previously these segments were growing at 40%. So what's happening? You're finally starting to see very slowly the consumer slowly get affected by these rates and these rate hikes. And why am I talking about why it's so important that the consumer gets whacked by these rate hikes? Well, It's because we need the consumer to stop spending so that earnings at companies go down, so that pricing power at most companies goes down, not necessarily all of them. Some companies will maintain pricing power. I think Tesla, for example, will maintain pricing power, but I've been saying that all year long. Hasn't done great for the stock performance all year long, but that's okay. Fundamentals sometimes take a while to play out. But the point is, these consumer spending items, like what we saw in the ADP report this morning, act with a substantial lag. Look at the wages report that we had right here. This is the wages report this morning. Where is the wage price pressure? Highlighted in green there. It's leisure hospitality. Where are the jobs? It's in leisure hospitality. Almost all of the other sections, or I will just say, with the exception of trade, transportation, and utilities, everything else is basically negative or close to negative. Leisure and hospitality is killing it. And that's, again, because it takes so long for higher rates at SOFR, LIBOR, Wall Street Prime, the Fed funds rate, variable terms. It takes a long time for those things to actually hit the consumer. It's not just enough to say, oh, but credit card rates are higher. Who cares? Again, all you do is you go to SoFi and you get a personal loan, and it's 1/3 the cost of your credit card. And I'm not even sponsored by SoFi. It's just the fact. That's why we're seeing consumer personal loan borrowing skyrocket, because they're just going from more expensive debt to debt that's actually a discount to what they've been used to beforehand. Therefore, the consumer keeps spending. So why is it so freaking important for the Federal Reserve to actually acknowledge a lag? Because, again, we don't want to turn into Japan. We don't want to be in a situation where the Fed does us so freaking dirty that they continue to hike at aggressive levels to where the terminal Fed funds rate ends up getting knocked up to 6 or 7%, and we just go into a depression. Forget recession. We go into full-blown depression. We don't necessarily have to have a recession again. We technically had a recession Q1, Q2 of 2022. That should make it easier to lap GDP numbers in Q1 and Q2 of 2023. We didn't have a negative quarter in in Q3 2022. So even if we're flat next quarter, Q1, Q2 of next year, we lap recessionary quarters. That means a year-over-year comparison. We're looking into a recession. Should be easier to beat those numbers as long as the Fed doesn't just totally kill this economy. And so this one line here, the committee taking into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activities. So freaking huge, like so critical, so happy about this. Oh, like this is like a weight off the shoulders. Finally a sign that they're actually paying attention. Now, what are the suits saying? The suits are telling me that the dollar is sliding to the day's new lows after this recent Fed hike. That's not a terrible surprise to me. I do expect the dollar to fall substantially once we get to peak Fed. Obviously, we're not at peak Fed yet. Then, stocks have now hit highs of the session with the S&P up 0.7%. Investors like this effective recognition that the Fed is closer to the end of its hiking cycle. Head of macro strategy at some securities firm says that cumulative and lags that they inserted that language will be taken into account favorably. Thank you. That's what I said. You're probably watching the stream. That's okay, Peter. I still appreciate you. In fact, I really appreciate you if you are watching the stream. That's cool. Next time you just have to throw in there, as Meet Kevin pointed out. Everybody sees it. Okay, I'm kidding. Anyway, Bloomberg Intelligence suggesting that it looks like the Treasury market is reacting when you look at break evens on a minute by minute basis. It looks like the Treasury market is reacting in a way that suggests the Fed is actually entering the end game of rate hikes. Let's see here. Some may view a Fed pause as leading to the risk of inflation remaining elevated. However, we think eventually the market adjusts its thinking towards a deeper economic slowdown in 2024 and therefore deeper cuts in rates thereafter. Interesting. The new sentences in the statement are reminding everybody of Vice Chair Brennard, who, what's the quote here? Brennard said last month, it will take time for the cumulative effect of tighter monetary policy to work through the economy. I just explained exactly how that works with consumers. And I always get people replying with this comment like, but baby, credit card rates are going up. It's not just freaking credit cards. Businesses get affected first. And what do businesses do? They lay people off. What did Open Door do? And I'm going to do a whole video on Open Door later. But what did Open Door do this morning? They laid off 18% of their workforce. Probably because A, they're going bankrupt, but B, that's what businesses do in hard economic times. You lay people off. And I tweeted this morning. This was probably a very, very critical note that I made this morning. And JPOW comes out in about 12 minutes, okay? So I tweeted the following this morning. And it's so important that, like, if you take anything away from me, don't even have to buy the course. You just don't even have to come back every day if you don't want to. I just want you to know me, Kevin, taught me this one thing, okay? Mommy and daddy don't stop spending at restaurants or on airfare to go visit Aunt Sally because of Jerome Powell. Mommy and daddy don't give a flying F about JPOW. They just don't. JPOW doesn't affect their daily lives. What affects their daily lives are the cost of eggs and chicken and, for grandparents, not enough Social Security coming in to pay for the electricity bill, right? That affects your daily life, not JPOW raising rates. JPOW going, I'm raising rates to bring down the cost of eggs is like, well, they're still high. It ain't working, okay? Mommy and daddy don't care about JPOW. Businesses care about JPOW, and that's why I write here, business borrowing via Wall Street Journal Prime, SOFR, and LIBOR. Those are affected by the rate hikes. So then businesses cut. When businesses cut, they lay people off. And let me tell you this, I guarantee you nobody has grown up with mommy and dad going, rates are higher, JPOW or the Fed has increased rates. We can't afford to have a steak dinner tonight. But I can guarantee you, if anybody's ever had, and I have had this, okay, I grew up broke. I've had my parents say, we just lost our job. And then what happens? Guess what? No steak dinner. You lose your job, then spending goes down. That's the last domino to fall. But you don't want to tighten so much that you end up destroying so many people's lives. And so that's why it's so critical that the Fed is actually changing a little bit of their tonality while still maintaining some hawkishness, maintaining some reasonable tonality that suggests, look, even though we're going to keep hawking here, we don't want to destroy America. And so them saying right here that we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affect economic activity, that is a game changer. That right here is a game-changing moment. This is a complete U-turn to what we had in December of last year. This is great. Now, I'm not calling for the Fed U-turn yet, but this is a stance U-turn. What are things that definitely lag, right? What are the big things right now? Well, first, unemployment, right? And joblessness. People getting fired lags rate hikes substantially. Again, if you don't believe me, all you have to do is look at this ADP report here. Look at where the jobs are being lost. Minus 17,000 information, minus 10,000 financial activity, minus 14,000 business services, education, health, minus 5, other services, minus 1, manufacturing, minus 20, construction may as well be flat, mining may as well be flat, goods producing on net, negative. Most of the prop up here, yes, we've got some in trade and transportation at 84,000. That's great. But right here, leisure and hospitality, which guess what? Transportation relates to, right? If you're in air traffic control and you're working at the airport and you're working in transportation, getting more kerosene to airplanes, you're supporting a large and growing leisure and hospitality space. So very, very good. Very happy about this. This subtle change here. Actually, it's more than subtle. It's pretty freaking blunt. So great news. Let's see. I want to take a look at some more about what the suits are saying, and then JPOW comes out in 8 minutes. I don't want to give any secrets away. So let's see. Okay, now the peak Fed funds futures are suggesting a 5% peak. That's below the 5.05% we were pricing it earlier. So that's a small pivot there on market pricing. That's not too big of a deal right there. This phrase, though, on lags and cumulative tightening is everything. No, obviously, indication yet that they're already convinced they're going to go 50 in December. I wouldn't expect them to really, go to make the argument or to say that, oh yeah, we're definitely going 50 in December. I don't expect Jerome Powell to say that because, again, 2 jobs reports and 2 CPI reports, right? Why would you make any kind of commitment? You wouldn't. You absolutely wouldn't. So let's see here. Immediate takeaways, ongoing increases, that's fine. We talked about the changes to the wording with lags, strike-through comparison. We talked about that. Everybody's actually talking about the sentence now, which is good. I mean, this is what we should be doing. So that's good. You've got interpreting the additional language. Yep, we're going Democratic lawmakers, some have been pressing the Fed to consider the damage of going too aggressively, might in particular appreciate the statement of the recognition of lagged effects. Yep. Okay, so Jay Powell coming up shortly. Let's take a brief listen over here to good old CNBC, and we'll see what they got to say.
Inflation, which is taking out some of these volatile elements like food and energy, is contained, is moving back to 2%. No evidence of that. And the Fed did get behind the curve. They've got to correct for that. I think actually their
10-year Treasury just fell below 4%.
These are the largest meeting rate increases that we've seen since the Fed started targeting the federal funds rate. So there were larger increases during the Volcker era, but that was not a period where the Fed actually said it had a target for the federal funds rate. So that's extraordinary, but they have to keep on doing it to basically make sure that people realize that no matter what, they're not.
You know, I just found on the internet you can't make anyone happy. Somebody's complaining that I made a reference to eating steak because apparently eating steak is inhumane.
Really kill the markets. They backed off, they lowered interest rates, and then they had to raise them another 1,000 bips, another 10 percentage points in order to get where they were, and that really killed the economy. So that was the worst recession in the post-war era. I don't think we're going to be there. I think the Fed is cognizant of this, but mistakes could be made. And I have to be honest, I actually think I'd rather have the mistake right now be made that the economy ends up a little softer than otherwise, rather than easing up and then really having to clobber the economy later. So, it's a balance of risks. It's not an easy business to do this. The Fed has made some mistakes and has got some very bad breaks. The Ukraine war is a nightmare for deciding on what to do policy-wise. It's a bad.
All right, I hear you, PG. Okay, so Jay Powell is now 5 minutes away from speaking. Actually, slightly less than 5 minutes, about 4 minutes and 20 seconds away from speaking. Jay Powell is generally extremely timely on his meetings. So I'm very excited for the Jay Powell commentary. This commentary is going to be everything. I think there is going to be a massive line of questioning about what Jay Powell means and what the committee means by these lags, right? Is he then going to use that as an opportunity to talk about the lags of shelter inflation? Is he going to use that as an opportunity to talk about the lags in the unemployment market, right? Those are going to be very important things we look at. The NASDAQ was down to 271 right before. We popped up almost a full 7 points. Right now we're sitting at 276 on QQQ, obviously an index tracking ETF here. We've got Tesla that also popped up from 221 to 224, still red on the day. Let's go ahead and just explore here. We got Chegg up 25% on an incredible earnings beat yesterday. Unify, they must have done a split. It's showing up as $10 now, up 8%. You've got Domino's up 4%, Coinbase up 4%, Nvidia up 4%, Wynn Resorts up 2.5%, Shopify a couple percent, Ethereum sitting at 1,600. Let's go ahead and drop down to Airbnb. Wow, SoFi even got hit here. Airbnb down about 8.4%, with SoFi down 7%. Cloudflare down about almost 4 right there with CrowdStrike. Probably some fears about softening in cloud spend. We've got a lot of earnings coming up as well. Earnings going to, of course, be a big deal. Earnings that we have coming up after the bell today are going to be Roku, Qualcomm, Etsy, eBay, Booking Holdings, Fastly, MGM Resort, Skills, Robinhood, Zillow, Sunrun, Fisker, Luminar, Red Robin, Elf Beauty, nobody cares about them. What else here? There's actually some consumer reports now that spending on like makeup and beauty is finally starting to slow. Tesla now down just 1% right there next to Trade Desk, down 1% as well. AMC and the Ape Squad folks still under $2 here. You know, if only somebody could have warned that this stupid stock, Ape, was going to go into the $1 range when it was $8. If only somebody would have made multiple videos and multiple tweets about that and would have put their own money where their mouth was and not only sold their stocks, but said bluntly to a community that hates it, if they could, they would short Ape because it's gonna go down. Oh, if only somebody did that. Oh, well. Okay, Open Door up about 2.5% on news of their layoffs here. When does Open Door report Open Door earnings? Let's see here. Open Door reports. I'm pretty sure Open Door reports tomorrow. Yes, Open Door reports tomorrow. I think they're soon to be Closed Door, honestly. Anyway, let's go ahead and prep now for JPOW. JPOW should be out within the next minute. I start playing clown music. No, we like Daddy Pow. We like Daddy Pow. All right. 30 seconds. 30 seconds to JPOW. That's exciting. You know, I'm going to be taking active notes here on JPOW as usual. I really appreciate the subtleties, and I enjoy I enjoy helping analyze all the madness that's going on. So thank you for being here. All right, here we go, folks. Y'all ready? Y'all ready for this? Dun-dun-dun. Make sure volume's on. Let me do a quick test. Hold on. He's not up. He's not out just yet. That's fine. Okay.
Is particularly.
Yeah, okay, that works. All right, everything's good. Okay. All right. Standing by. Where's Daddy Pow? Come on, Daddy. Where is he? He's always on time. I've never seen this guy late. He's got another 15 seconds. Don't disappoint, Daddy. Hold on, I'll go get him. Got him.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
50 basis points, fine, whatever.
Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
SEP will be up.
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Yeah.
We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Okay.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Okay.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. Let's hear it.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Yeah, and just so you know, why we see red is because they said that rates are going to have to go higher than what we've previously anticipated, that 4.6% on the S&P.
Confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
We don't know.
So what I want to do is put that question of pace in the context of our broader tightening program, if I may. And talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover, but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion.
Good.
To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this. And as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Yeah. It's good. It's good so far. This is very reasonable.
The Wall Street Journal.
Nikki
Chair
Leaks.
Powell,
That's him.
Core
That's
PCE
him.
inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Yeah, that's not his job. Not my job, as he says.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times.
New York.
I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Ooh.
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched.
Nope.
And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Yep. Wage spiral.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, talk to us about the lag.
The way I would think about that is it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do? Yep. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we
don't want to hear that.
If we don't get inflation,
don't say that,
under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Red candles on that one. I mean, he's never said anything otherwise.
Thanks, Chair Powell. Neil Irwin with Axios.
Still hiking.
As you look around
just at a smaller pace.
Impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages. So I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening, and maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that'll be discovered empirically.
We'll find out on time. This CNBC is next.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy. And we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior
Goes
from
on
becoming
circles on this every time.
common.
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standards.
I hate to say it, like this part is just so boring. I'm gonna jump over here and fast forward a little bit.
Program that we have is up now and running, and actually it was through that the problems with President Bostic's.
But you know what? The more he talks about these like trading problems or whatever, the less chance he has to drop stocks even more. Treasury yields back up to 4.06, and stock market back down on NASDAQ to 1.3 to the downside.
Has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't.
Losing viewers here.
So,
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that. What's the level we need to get to rates. And I don't know what we'll do when we get there. By the way, it doesn't we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Mm-hmm.
Thanks, Chris. Rugaber.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures.
Yes.
And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on?
Thank you.
Or will you still focus as much on the more lagging government indicators?
Ooh, smart.
This is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary
Fine,
policy.
but it lags.
And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the
changes.
The at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did. And now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay. But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Good. Okay. All right.
And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is
don't ruin it.
That we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target? In
theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending.
Yep.
Even in so I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Last question. Then
Hi,
summary.
Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Wow. All right. Let's go ahead and do a recap. That's a lot of intel right there. Woo, boy. All right. So let's go ahead and do a full recap. Takeaways and all charts, changes. Let's go ahead and get right into it. All right. And goodbye, Sarah. See you at earnings, maybe for the closing bell. All right. Push some buttons. Let's go. There we go. Well, it's too soon to say that the Federal Reserve has turned dovish. As expected, the Federal Reserve had to stay hawkish, but they gave us some hints of how things could potentially turn dovish that we weren't expecting, which initially led stocks to rally a bit, but that was quickly put to bed, especially as Jerome Powell told us that the path to a soft landing has narrowed. The window is shutting, specifically because we expect to stay at higher rates for longer. Jerome Powell made it very clear that if today we were going to do a summary of economic projections, which we last did in September, we would once again, which has been consistent for the past year, revise our expectations up. Keep in mind the summary of economic projections has a terminal Fed funds rate projection of 4.6% before you turning down. Now, Jerome Powell is suggesting that would go higher. How much higher, we could really only determine based on some of the things that we've heard from Nikki Leaks over at the Wall Street Journal, whom over the last few days suggested that the Federal Reserve sees the potential for a terminal Fed funds rate between 5.25% to 5.5%. And of course, as inflation continues to be more broad and persistent, we get a more restrictive path that is necessary. We did get some answers to big questions that we had, like, is the Fed just totally blind to the fact that if you subtracted shelter inflation from CPI, we would be at 0% inflation? Jerome Powell actually gave us an answer. Unfortunately, it wasn't the answer we wanted. It was an answer that just plays into the Great Reset playbook that the Federal Reserve is just here to ream us. And the answer was, yeah, we know you could take out shelter inflation and basically recognize that inflation is zero and that some of the recent leases signed on the margin, so the recent ones, are suggesting that rental rates are coming down, but they're coming down from a level that's actually higher than where CPI is even recognizing that inflation is. In other words, suggesting we actually have more up to do before we go down. This is actually consistent with what JP Morgan suggested, that shelter inflation would probably remain at a month-over-month rate of somewhere around 0.7 to 0.8% for another year, which is really bad because that suggests somewhere between 8.4 to 9.6% inflation from a segment of a CPI report that eats up like 32% of CPI and somewhere around 20 to 25% of PCE. And so while Jerome Powell said we're well aware of that, unfortunately, he's also well aware that rents overall are still trending up. And even though on the margin they've trended down, we still have more pain coming. So he's focused on that overall CPI picture. This led markets to be understandably a little bit sad and questioning the Federal Reserve's path, especially when they talk about this idea of, hey, I thought y'all were going to slow down, which should not be considered a pause. Jerome Powell said at least 3 times that it is way too premature to talk about a pause. A pause means no longer raising rates. Instead, Jerome Powell talked about 3 steps and 3 core questions. How fast should interest rates be raised? And he suggested, look, we've got to move into a more restrictive territory. And he fumbled a little bit on one question when we said, as we move into restrictive territory, and then kind of corrected himself and said, as we continue to raise rates, suggesting he realizes we're in a restrictive territory, but ended up saying, even though we're in a restrictive territory, we still need to keep hiking. Now, we might hike at a slower pace. The CPI data that comes out over the next 2 reports between this Fed meeting and the next Fed meeting could lead us to slow our pace of rate hikes in December to 50 basis points or in the meeting after this December. Again, depending on reports, Jerome Powell said the slowdown may come within the next 2 meetings and as soon as the next meeting. However, that's not to be confused with the fact that they could actually just keep hiking rates at just smaller increments. For example, if we go from 3.75 to 4.25 with a 50 basis point hike next, but then we go 25, 25, 25, 25, 25, we could be at 5.5 or 6%, even with 25 basis point hikes. And so that's the second question, is how high do we go? And all Jerome Powell gave us here is we still have ground to cover. In other words, we still have rates to hike. So sure, the individual meeting to meeting hikes might be a little slower starting in December, but what really matters is not how fast we're hiking them anymore. What actually matters more is where we end up which could be higher and would be higher if we had to decide today than what we previously expected. On top of that, and this is still to be determined, is how long do we actually stay at those higher, more restrictive rates? Now, markets, of course, were very, very enthusiastic when we got this blue text added to the policy statement, which suggested that in determining the pace of the future increases for the target rate, the committee will look into and account for the cumulative tightening of monetary policy and the lags at which monetary policy works. As this statement first came out, I talked about something that Jerome Powell also ended up talking about. And that's that the first thing that happens is the Federal Reserve tightens rates, or markets anticipate the Federal Reserve tightening rates. Then you see economic activity slow down, which generally starts with businesses, business fixed investment coming down, as Jerome Powell told us in today's meeting. You also start seeing interest-sensitive sectors like housing slow down, and also, again, business investment, because businesses that are investing tend to utilize rates that are based on things like the Wall Street prime rate, the SOFR rate, the LIBOR rate. These are all rates that move right with the Fed funds rate. Jerome Powell made it clear that consumers usually don't borrow at this rate, so there can be a lag in when consumers react. And then only after the Fed acts, financial conditions tightening, business economic activity tightens, and consumer activity tightens, then we start seeing inflation come down. And so we have no clear charted path as to how long it's going to take, but he does recognize that there are lags. Now, while that lag talk was really enthusiastic or created a lot of enthusiasm for markets, Jerome Powell kind of ruined it really quickly, because he essentially told us, look, if we over tighten, we could just turn the money printer on again. This was not what markets wanted to hear. Markets didn't want to hear, yay, worst case scenario, if we over tighten, we'll just turn the money printer on. So markets saw something that kind of looked dovish, but then got really sad because they realized Jerome Powell would rather over tighten and then stimulate than not tighten enough and lose control of inflation and have inflation become entrenched. Unfortunately, that's bad news for the stock market, which means stocks down, and bad news for bonds, which means bonds down and yields up. Because what you're saying here is Jerome Powell in today's meeting tells us, hey, I don't think we've over tightened yet, but we would rather over tighten than under tighten. So in other words, we still haven't done, the real damage, and we can keep going, and we would rather keep going than pause too early. This is why I made it very, very clear that we are not expecting a pause anytime soon. Maybe we'll expect a slowdown in how quickly we move interest rates up. Regarding a wage spiral, Jerome Powell says we don't see a wage spiral right now. However, once you see it, it's already too late. You're in trouble. So that was not exactly what we wanted to hear. However, there was something slightly bullish in that, hey, Jerome Powell thinks we can actually end up seeing the jobs market cool just by having opens come down, job openings come down, without actually seeing unemployment go up. Personally, I think that's bullcrap. Personally, I think you need to see unemployment come up. And I think that's more of a political statement that basically says, yeah, we could do this without causing joblessness. Yeah, right. Like I said, before the meeting, and on Twitter, follow me there at RealMeKevin. I said it both before the meeting and on Twitter. Before the meeting. Mom and dad don't skip out on travel and a steak dinner because Jay Powell raised rates. But they do skip out on travel and a steak dinner when they lose their jobs. That's when consumers get affected. And that's the kind of lag that we're waiting to actually take hold of markets, but we just haven't seen it yet, especially since consumer spending is still growing and household spending might even be offsetting government spending that we previously had. Something Jerome Powell talked about, the shift of fiscal spending to household spending because household balance sheets are so strong. He does suggest that or re-suggest the importance of the housing market coming back into balance. This is an area that he believes is very overheated and has been very overheated, and that there's still more work to be done in the housing market. Remember that Jerome Powell was the one who told us, hey, if you're a first-time home buyer, I might wait for more of a reset in the housing market before buying. and this is something I've been talking to all the course members about in the real estate investing course when we do deal analysis and we look at comparable sales and investment opportunities, say, you know what, just probably not the best time yet, but stay tuned. Same is true for House Hack. We're waiting. But anyway, balance sheet is still being reduced. Not too much insight into the balance sheet. Are concerned about inflation break-evens starting to trend a little bit higher. This is a big concern, actually, is the potential for inflation break-evens to move even higher than where we've been used to. If you could see this chart here over the last year, we've started to see inflation break-evens move up again on the right side. That's not the direction that we want to go in. And when asked about the inversion of the 3-month real bond yield curve, we are close to it, but not there yet. However, once we see that inversion, we tend to confirm a recession, as you can see depicted graphically here. So basically, Jerome Powell tells us, yeah, look, there are lags in the economy, and it takes time to bring inflation down, but we're in an unprecedented time, and we'd rather hike more than do too little. So in other words, keep shorting, sell your stocks, get out of margin because he's about to get hosed, and enjoy as we continue to tighten rates more at the Federal Reserve for longer. Again, remember, you could be at 3.75, and I just want you to think for a moment about how this could go, because there's no this whole like pause talk is nonsense. There's no pause yet, right? What we really want to pay attention to is the following. Take a look on screen now. You go from where we sit now, 3.75%, and just go to 4.25% with a 50 basis point hike. Watch, we do another 50 basis point hike, and then you just go 25s, right? Then you could be at 5%. So let's say this could be December right here. Let me get the full calendar, and I can give you actual dates as well. Fed FOMC meeting calendar. So this right here would be November 2, 2022. Then we've got December is next. And, oh, that is the wrong calendar. Come on, Kevin. Fed. Here we go. December 14th. December 14th, we could be at 4.25. January 27th, right before my birthday, 2023, we could be here. And this would be a 75, 50, 50, 25, right? You could see something like this. This would be March 17, 2023. Then you could see April 28, 2023, again, another 25, right? You could see this continued hiking for quite a while. And so this idea that, oh, the Fed's ready to reduce rates, not necessary. June 16, July 28, 2023, right? I mean, look at how long this could keep going. You could be at 5.5% right here. You could be at 5.75% right here. And quite frankly, by September of next year, 22nd, 23, you could be at a 6% Fed funds rate. Entirely possible. Now, we don't want to go to those levels, but even with 25s, you could get to 6% before September. That's scary. You know, if now you start moving at 50 basis point hikes, it moves even faster. But it shows you, like, now we're not so worried about this decline right here. Certainly the market shouldn't be so worried about this move from going from 75 to 50. That's not where we go bullish. Where we go bullish is, in my opinion, when we start seeing something like this, where we go, oh, we're going to cut rates by -25. But how much time is between hikes and cuts? And that is all a big old question mark. But something that'll never be a question mark is your opportunity to get life insurance in as little as 5 minutes by going to metkevin.com/life. Using that Halloween coupon code, we're changing the pricing this afternoon to November pricing. So slide in if you still can, if that coupon still works. And of course, get yourself 12 free stocks with Webull by going to metkevin.com/Webull. Thanks so much for being here. See you in the next one. Good luck.